thrilled to be here with Jenny Johnson, who is the CEO of Franklin Templeton, now based in Florida, right?
Yes.
Just got in this morning. We're going to start with a big macro conversation, and then we'll wind our way to what Franklin Templeton is doing and maybe get Jenny's take at the end on what she feels good about in this current environment. When you look at what's going on in the world, we know inflation has come down dramatically, but it's still not down enough. We know the US labor market has softened, but it's still, holding up pretty well, so consumers are still spending. And so when you add it all up, there is a noticeable slowdown in the economy, but no recession, right? And that's despite all these calls over the past year that some kind of recession was happening. So, Jenny, start us off by giving us your read on the macroeconomic environment. Are we past the worst, or is the worst yet to come?
Well, the recession, it's funny, this chair sort of makes you fall back.
I know. I sit at the front of it so that I don't fall back.
Look, I think we've been waiting for this recession for 2 years now. And, inflation is proving much more resilient than many people thought. The consumer is still strong. Unemployment, this month in January were the lowest since 1969 or something, right? I mean, so there's a lot of things that are still really strong, and the consumer is still spending. Let's face it, the Fed didn't tap the brakes. The Fed jammed on the brakes with rates. The good news is inflation came from 9 to 5, but it's going to be hard, I think, to get it to the next level. Banks are actually, despite the regional bank issues, this is not 2008 bank crisis, which was really about bad assets. This is about things like duration. And if we think about SVB, that was US Treasury. So it wasn't like a bad investment. It was just the timing. And then, on the asset liability mix, I always say to people, remember, even if JP Morgan had 40% of their depositors pull their money out in 1 hour, they would have had an asset liability problem. So there's a lot of things we're learning about, but it feels like that has been, ring fenced. And I think what we'll have is a mild recession as opposed to a real deep recession.
Okay, so that's what's happening with the US economy and to some extent the global economy, but something your clients I know are thinking a lot about is geopolitical tensions, particularly between the US and China, which has kind of divided the world into Team USA versus Team China. Who are you with? Your firm, of course, is known for its huge global franchise. What do you see as the implications for investment in China and other overseas markets?
So I think, a couple things. I think that if you look at it like Russia, Ukraine, I have yet to hear anybody who tells you what they think could be any type of short-term resolution on that. So it feels like that's just going to be there for a long time, and that's going to obviously impact things in Europe, things like energy security, food security, and from an investment standpoint, you're always going to be looking at where the trend's going. I think US and China, the political tensions aren't changing, and the world, as you said, are kind of choosing which side. And so one of the themes that we see, and I think we learned during COVID that, if you had a supply chain, you were only strong as your weakest link. And so we'd say there's kind of 3 trends on the supply chain side. So there's a China plus one, there's a friend-shoring and near-shoring. And so the China plus one is, look, China's still probably the cheapest manufacturing. So you'd maybe love to move your supply chain somewhere else, but you can't pass that on to the consumer. So you're looking to diversify. And India, for example, is becoming a great beneficiary. We just saw that Cisco is opening up and investing in a manufacturing plant there. So you're starting to see places like India, Vietnam, others that in the emerging markets that are benefiting from the China plus one story. The friend-shoring is you're seeing people who are choosing a side. The Taiwanese chip maker that is investing $5 billion in Japan, is not doing it because they could produce chips cheaply in Japan. They're doing it because Japan sits under the sort of defense umbrella of the US. And then nearshoring, places like Mexico to the US. So anywhere where manufacturing's happening, that you can bring it closer so you have more real-time delivery, I think are going to be beneficiaries. So I think those are broad themes that come out of the current environment. And then you see places like the Middle East and India that are sort of choosing to stay playing both sides of it. And that can be frustrating to us as Americans because we look at that and say, wait a second, we're used to people doing what we want them to do, but countries are going to act in their own self-interest. And so in some cases, they feel it's a better move to be more neutral.
Okay, so that would argue for a more tailored approach to investing, a more thoughtful approach to investing as opposed to...
Like active investing?
You said it, I didn't say it, but yeah, that would be the argument for it. So having said that, what do fund flows into and out of Franklin Templeton this year tell us about how investors see the economy right now in the short term and then further down the road in the long term?
So you for sure see a lot of flows into the short term, like money market funds, right? I mean, here you can get almost a 5% yield sitting there in a money market fund. You're definitely, fixed income still is higher in the capital stock as, versus equity. And so, if you can get high yield returns at 8.5, investment grade at a little over 5%, you're definitely seeing movements into those. I think there's a really interesting phenomena going on where, the market sort of priced in, say, a 75 basis point cut in between now and say December, and yet high yield spreads are actually down a bit. Which high yield spreads when they shrink, it's usually because people think that defaults are going to go up and the economy is going to slow down. The opposite. People think that actually high yield's a good place to be because they think there aren't going to be a lot of defaults and the economy is more resilient. So you have this kind of dichotomy going on that you see with investors. And then I think equity's been you haven't seen people move completely back into equities yet.
A little bit
alternatives, obviously great traction in different areas of alternatives.
All right, we'll get into alternatives a little bit later along with equities and fixed income, but you had mentioned banks and the regional bank stress, so that's where I want to go because obviously the Fed hiked rates aggressively from near zero to more than 5% in just over a year, so that rate of change was massive. The fear is that the Fed won't ease until it breaks something. Did it break the regional banking business model, which for years feasted on low rates?
Look, I don't think it broke the regional banking model. It broke some banks, and there were multiple factors in that, so it wasn't all the Fed. But obviously, the hike in rates, the quick hike in rates, was a factor in that. But regional banks and community banks play a very important role in our economy, where they are lending to those communities in a way that I'm not sure the funding would happen by some of the bigger banks. So. I think it's going to be important that those survive in this, and I do think, barring some sort of social media push that makes people lose confidence in a particular name, I think and you see it in the recovery in some of the regional bank stocks that I think we're it feels like we're sort of past that. That's why I think maybe the Fed pauses in June. I think they're going to be data driven. They've got a couple of prints, both in core inflation and unemployment before the meeting. But it wouldn't surprise me if they say we're going to pause on any increases because why add more stress into any of the banking system?
And of course, one thing that everyone's watching for when it comes to the regional banks that haven't collapsed and that are still doing okay, maybe struggling a little bit here and about to tighten lending standards, is what happens with their exposure to commercial real estate. And this feels like it's going to be the next shoe to drop. What are you hearing on your end when it comes to those concerns?
So it's really interesting because I think in the commercial, community banks, regional banks, and small banks account for about 25% of the lending in the commercial real estate market. And the way people talk, it's like, commercial real estate is going to be terrible. There is definitely going to be stress in the commercial real estate market, particularly in office. We just saw that housing starts are starting back up. The reality is the U.S. underbuilt residential properties, and there's going to be a while before that catches up. And in the case of residential, you have Fannie Mae and Freddie Mac that can take out once it's built, they can provide the mortgage lending. And then there's another interesting phenomenon going on in the residential side, which is apparently the supply of homes for sale has dropped because people who have low mortgages don't want to get out. They're like, I'll stay here because I'm not going to go sell and go move to something else and have my mortgage double.
Yeah.
So I think, in that particular area, what we see is industrial has strong demand on the tenant side. Residential, still very solid. Non-mall retail is still pretty good. Harder to get development, construction loans. That's going to be where I think private credit's going to step in, where the banks are probably going to retreat, and you're going to see some stress there. And I think office is going to be an issue.
So steer clear of office. Okay. A lot of this, when it comes to banking, and I know you've described banking as a game of confidence. It works when people have certitude that their money is safe. Investing is as much a game of confidence, isn't it? What is the quality of the investor confidence out there right now? Is it fragile? Is it resilient? How flighty or how consistent is it?
Well, I think people, flows into the fixed income area have been really strong. I think people are excited that they can actually get returns in the fixed income market.
And not go out too far in the risk spectrum.
And not go out too far in the risk spectrum. And, frankly, I still like and they haven't performed that well, but, good old dividend paying, good cash flow equities. Those multiples haven't kind of, increased. So I think, playing it where, again, that's assuming a mild recession, I think there's some good places to invest. And most importantly, we're reminded every time, diversification. It is so important to come in with a diversified portfolio.
Mm-hmm. And we'll definitely talk about diversification when it comes to alternative investments, but overshadowing all of this, at least right now, is what's happening in DC at the moment with the debt ceiling standoff. Both sides have made clear that default is not an option. We heard from leadership from the Democrats and Republicans yesterday saying, we're not going to default. Default is not an option. That would be terrible. But they're engaging in grandstanding. Do you think there's too much complacency in financial markets that a deal will definitely get done at the last minute, maybe May 31st?
Yeah, and I don't know that anybody really knows if June 1st is the X date. I think that they're a lot of different views on what
Janet Yellen says it's June 1st.
And if you're Janet Yellen, why not put that date out there so that you can kind of hope that Congress will resolve it sooner? But it's definitely weeks and maybe a month and a half that you have this X date. Look, it's embarrassing as a country that we get to this point. But let's remember, we're not Greece or Argentina, right? Just imagine that you're holding a defaulted U.S. Treasury, and I don't think it'll default. So let me be clear. I think that they will come to agreement at the 11th hour. There's no point in doing it before the 11th hour. You get all the drama that it's there. But they will come to agreement. But let's say they didn't, and you're holding that U.S. Treasury. What kind of discount are you actually going to sell it for? You're going to get paid, right? And so, unlike other situations where maybe a country's essentially insolvent, the U.S. is still probably the best credit out there. And so, I think we'll get a lot of volatility in the market, but, my instinct is they will get a deal before we ever get to that point.
That's what I hear too when we talk to people on TV. Everyone says there's going to be, maybe it could get really messy, but in the end it will get done. So I wonder, even if there is a deal that is struck this time at the very end, these regular games of chicken are now the new normal. We've kind of factored that in. Do you think there's a long-term cost to confidence in U.S. creditworthiness as a result?
The challenge, though, is where else are you going to go, right? There's a reason that the dollar is the reserve currency. It is, despite all of this, people still have faith in the U.S. will pay their bills, that the laws are consistent. Like I said, it gets embarrassing. People know they get to the edge, but in the end, they know they're going to get paid.
Yeah, I think that's a really good way of thinking about it. Where else are you going to go? But after a couple of years of this, people will start to come up with alternatives. Do you think investors will eventually seek out some permanent alternative? China wants to make its currency.
Well, and they will chip away at it. I mean,
yeah.
China's demanding that certain trade deals are done in the yuan, and so. I think it's gone up from something like 4% of trade to 6% of trade. The U.S. dollar is something like 84%. So, that it ties it to the dollar. So, you will definitely see a chipping away of it. But there's just a confidence with the dollar that you can sort of, despite our debt ceiling issue, that there's a confidence around how the U.S. government will behave, the laws in the government, and therefore that you can have confidence around, trading in the dollar.
Right. Nevertheless, as you said, there is going to be some diversification on other countries' parts to spread the risk a little bit. Speaking of diversification, let's go back to what you've been doing at Franklin Templeton, because you've been CEO since 2020, and since then, the firm has been on a buying spree. You've made 9 acquisitions in 3 years. The biggest, of course, was Legg Mason in 2020. The most recent was Alcentra, which is a push into European private credit. Most of these transactions in private assets, alternative assets. Tell me how client demand for access to private markets has evolved over the years.
I mean, we knew we had to enter the private market space just because if you look at just this secular trend, look at US companies in 2000 were going public on average after 3 years. By 2019, that number was like 9 to 10 years. By 2022, that was 14 to 15 years. Now you can look at that and say, well, some of it, maybe 2000, it was all the .com. I mean, but that's a massive change, right? And there's reasons why CEOs are choosing not to go public sooner. There's the pressure on quarterly earnings makes it sometimes harder to make investments in something that won't pay off for a few years. There's a variety of reasons. And it used to be you had to go public because you also had to monetize your employees, stock. So they had to have a way. Well, now there's a whole secondary markets and trading here. So we think the going private, even with interest rates being higher, doesn't go away. That people will delay longer before they go public. And then in private credit, you look at 2008, Basel III in Europe and Dodd-Frank in the US just made it so that it's much more difficult. Banks, it costs them a lot more of their capital to allocate to lending. So they're just not lending like they used to. And so that has created this massive increase in private credit. So today we have $82 billion in private credit. We saw the institutional clients allocating to this space. And we know that it will also get democratized and ultimately be brought into the wealth and the retail channel. And so we looked at that and said, we want to make sure that we have a full spectrum of capabilities to bring to our clients so that we have the full spectrum of solutions.
So I like what you said about how institutional investors have been allocating to alternatives for a while now, and individual investors are just starting to do that. Where would you say we are in that transition for individual investors? Is it the second inning, the fifth inning?
I'd say, today about 5% of the wealth channel is in alternatives, and the feeling is that should probably move to 20%. And if you just take the 4 biggest sort of U.S. wirehouses out there, and for each 1% they increase allocation to alternatives, that's about 130 billion increase in alternative. I think we're in the first quarter.
Okay, first quarter.
But yeah, I like that you use baseball. That was good. So
second inning?
Yeah, second, third. Yeah.
Okay, second or third inning. All right.
Second inning. We'll go second.
Big Giants fan over here. What about how your customer base?
I'm wearing Dodger colors. Ouch.
Yeah, why is that? Or Kansas City.
Yeah, there you go.
How has your client base changed as a result of your becoming one of the biggest managers of alternative investments? Because again, it used to be the domain of institutional investors, but now individual investors are looking to do the same.
So when we acquired Legg Mason, they were 75% institutional. We were 25% institutional. Now we're 50-50. About 50% of our clients are institutional, and about 50% of them are on the retail side. And we think that that's a perfect combination. Understanding the mindset of that retail wealth channel and being able to bring the complexity of the products of the, that have historically just been institutional, of the private markets. We think that we're that perfectly placed because there's a lot of complexity. I always say that it's the tip of the spear in the private markets that's most important, which is that advisor figuring out exactly what's right for an individual client. If you're an institution, you go sell to a big pension fund, somebody's making a decision and boom, you get, hundreds of millions, if not billions of dollars. A financial advisor is deciding this client can take private assets, illiquidity, this client can't. And it's quite complicated in how that has to be sold at the end.
Sure. And of course, the pitch for investing in private credit is the rewards, right? They're higher. You get uncorrelated returns. Banks are holding back on lending, so there's a lot of opportunity as well. But what about the risks? What is the single biggest risk that individuals face? Because these are not liquid investments.
Right. I think that's the biggest risk, right? Is that you really want to make sure. So we are spending a huge amount of time. We have 30 specialists that just support our retail wholesaling network to talk to clients about that risk of illiquidity, right? So the worst thing is when you have an individual who, who thought they could sell the asset and suddenly needs the money for something and it's tied up, and that's a problem. And I actually love the 401k channel although not everybody has access to it, but the 401k channel, if you bundle private credit or private assets into kind of a managed account solution, and you've got cash flows coming in with every paycheck, so the fund always has assets coming in. It's a really nice way to give exposure to the alternative space, and most of them have kind of a lending mechanism that if you have some sort of event come up in your life, you can borrow against your assets there. So I actually think that's a great way. So we're spending a lot of time trying to deliver it through that. But there's also, with advisors, it's really about the education to ensure that the end client understands it.
Right. And of course, Franklin Templeton bears a big responsibility for that. When we talk about private credit, it's a pretty big term. It's an umbrella term, really, because there's all these different kinds of strategies, right? There's direct lending, there's distressed, there's infrastructure debt, real estate debt, and that's just a few of them. Which strategy is most accessible to individuals?
Well, I think it's less of the strategy than it is the vehicle, right? And so you can do it in what's called a BDC, which is almost like a closed-end fund. So, you can buy in shares and sell shares to other people in that, or you can have these kind of interval funds where they allow a certain percentage every quarter where you can, get in the queue to liquidate. So I think it's more of the vehicle, and then they can do a lot of different types of assets in there.
You had said that you believe private markets will perform well even with interest rates rising. I mean, a lot of these firms were born after the great financial crisis when we had near zero rates for many, many years. What kind of strategies are best positioned in this current environment where rates are likely to stay higher for longer?
Yeah, so it's interesting in the private credit space. I get, Franklin has, I think, about $600 billion in traditional fixed income and 82 billion in private credit. There'll be a debate between the various teams about which is better right now. Like the traditional guys will say, look, you're getting an 8.5% yield in high yield that's completely liquid. Why would you go in and do 9, 10, 11% in the private credit? And they'd argue in the private credit, well, maybe it's, more investment grade assets. So, I think that's interesting. It depends on what your individual need. And I'll tell you the space I also love right now is secondary private equity. And so...
Explain what that is.
Okay, so there's been $6 trillion deployed in private equity, and there's been about 140 billion raised in secondary PE. And so what happens is, let's say you're running a pension fund, and you've got an investment allocation that says I can have X amount to the private markets, and it's, private equity, private credit, and then I've got my traditional investments. Yeah. And you think about 2022, your equity portfolio was down 22%, your fixed income portfolio was down 15%. You still had to pay your pensioners, so you had to take it from your liquid assets. So now you're facing your quarter and you're like, oh my gosh, I'm overexposed in these private markets. And so they'll call up a secondary, and this is a real transaction. We own Lexington Partners, that they had, a large state pension said, I need you to take $1 billion out of my private markets assets in 30 days. So they'll go in and they can cherry pick which funds they want. They keep track of all the big private equity firms, and they have very good relationships. They cherry pick the funds, and then they can buy it at a discount. And the discount isn't so much based on, one, it can obviously be based on what you think the current market value is, but it's also because there isn't that much in private credit that's been, secondary PE that's been raised. So they're getting discounts in the 20, venture discounts are up to almost 50%. But, they'll get a 20% discount for private equity, private credit, real estate's in the high 70s. So I think it's an amazing opportunity for anybody right now.
But at the same time, for people to allocate to alternatives, they're taking it out from traditional asset classes like stocks and bonds. What is the outlook for old-fashioned stocks and bonds right now?
Well, like I said, I think, fixed income, it's a great time to be in fixed income in a way that it hasn't been for a long time.
Rates.
Yeah. So I think it's, and frankly, with the equity markets, we've seen them come back. Usually when the Fed peaks on the cycle, and maybe we're there, maybe we got a little bit more, but we're getting close to the peak. You see equity markets, they tend to actually lag the fixed income a little bit for the first, say, half of the year, but they come back after, right? And so I actually think it's, we took the brunt of the pain last year in the equity markets.
Okay, we have 10 seconds left, so I promised I would ask you one question. We talked about a lot of gloomy things. What are you most optimistic about? What are you confident about?
I'm confident about human nature's resilience and innovation. And when I hear things like AI is going to put everybody, all these jobs out of business, I always think about in 1899, the head of the US Patent Office said we should shut down because everything that's been invented has already been invented, right? We can only often see what's in front of us, but it's using those tools are what actually launch us. I mean, think about Google, the internet was going to put a bunch of jobs out. Think how many jobs were created by that. So I just believe in the human resiliency to always find ways to innovate.
So technology means the best is yet to come.
Yeah, there you go.
Jenny Johnson, CEO of Franklin Templeton, thank you so much.